At first glance, the market looks fine. Stocks are near highs. Volatility looks calm. Headlines sound optimistic. But markets don't break when things look bad. They break when things look too comfortable. And right now, one signal is flashing that most investors are ignoring. Every major market downturn had something in common. Not panic, not chaos, but confidence. Confidence right before reality sets in. The stock market doesn't warn loudly. It whispers first. And the signal it's whispering right now is divergence. Divergence happens when prices move up, but the foundation underneath weakens. Indexes rise, but fewer stocks participate. Optimism increases, but risk builds quietly. Confidence grows, but liquidity tightens. This is how trouble starts. Major indexes are being carried by a small group of stocks. A handful of mega-cap names are pulling the averages higher, while many stocks underneath are lagging or falling. This happened before the dot-com crash and the 2008 crisis.
The surface looked strong. The structure was weak. Another warning sign is volatility complacency. Volatility measures fear. When investors believe nothing can go wrong, volatility collapses.
But extremely low volatility has historically appeared before sharp market moves, not after them. Calm doesn't mean safe. It often means blind. Then there's credit stress. Stocks can stay optimistic longer than credit markets. When credit spreads widen and lending tightens, it signals growing risk under the surface. Pressure builds, even if stock prices haven't reacted yet. Now let's talk about interest rates. Markets assume rate cuts are bullish. But historically, the first rate cuts usually happen because something is breaking, not because everything is fine. In 2001, 2008, and 2020, the market falls when earnings crack under pressure. Another signal is earnings quality. When companies beat expectations by cutting costs instead of growing revenue, it's not strength, it's survival. Margins can't be cut forever. Consumer behavior is another quiet warning. When spending slows and savings fall, earnings pressure follows. Markets often ignore this until they can't. This is how market trouble actually develops. Slowly, confidence rises, risk builds, liquidity tightens, and then one trigger changes sentiment fast. Retail investors usually react too late. They buy when it feels safe. They sell when fear feels unbearable. Smart money watches behavior. When everyone is positioned the same way, risk increases. Crowded trades don't fail because they're wrong. They fail because everyone tries to exit at once. This doesn't mean a crash is guaranteed. But when signals stack up, smart investors prepare. Preparation looks boring. It means reducing leverage, managing size, holding liquidity, and avoiding emotional decisions. The market always looks strongest before it shows weakness. It doesn't predict timing. It reveals fragility. The biggest losses don't come from being wrong. They come from being overconfident. Right now, the market looks strong. But strength without support is an illusion. And illusion breaks fast. The real question is, are you prepared if confidence disappears? Follow for real market insights, not hype and not financial noise.